Today, the difference a day makes. Hello, it's Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly, our latest digest of finance and property news to the 5th of January 2019. And there's a lot to talk about today because the markets have continued their volatility and we had some very interesting perspectives from the US Fed. But before we start, just a quick reminder. If you would like to support our activities, you can do so via our Patreon program. Here is a link to that. Or make a one-off contribution via PayPal, and here is a link for that. We really do appreciate your support in enabling us to continue to make great content. And I'll also add that we are continuing to experiment with our green screen background. So today we have a general finance theme. Tell me what you think. It was interesting, I got quite a few different comments yesterday relating to the local scenes in and around Thirroul, which is where I live. And some people thought it was great, other people thought it was distracting. So I can't win, can I really? Anyway, we'll try this for today. So now, down to business. And we're going to start by looking at the local market activity. So on Friday, the ASX 100 closed 0.19% down, to 4,642.90. And you can see there the volatility through the week. There was a significant dive earlier in the week, and I guess the thematic really is about ongoing volatility. Remember that trading is still very light, so any upward or downward movements are likely to be accentuated simply because of the light volumes. Now turning to the ASX Financial Index, that was down 0.34%, to end at 5,529.30. And again, you can see the dip earlier in the week, and once again, it's on low volume. If we start looking then at the individual banks, ANZ was down 0.37% to end at 24.25. The CBA was up 0.07% to end at 71.89. National Australia Bank was up 0.21% to end at 23.98. And Westpac was down 0.04% to 25.03. And of course all the majors suffered those significant drops earlier in the week, but I think they've also rebounded on Frydenberg's comment a couple of days ago that the banks should be lending more, and we'll talk about that a bit later. Among the regionals, Suncorp was down 3% to end at 12.29. The Bank of Queensland was down 0.62% to end at 9.58, and Bendigo and Adelaide Bank was down 0.19% to end at 10.60. So there's a bit of a rotation going on from the regionals to the majors, and again I suspect that's part of this idea that maybe the majors will be lending more ahead. Macquarie Group, of course, exposure internationally, was down 0.38% to end at 109.41. And AMP continues to languish, down 2.02% to end at 2.42. And you can see there that they continue to struggle. And I continue to ask the question about, well, what is AMP now? How do you value it? It's very hard given recent events, particularly in relation to the Royal Commission. The Mortgage Choice, the mortgage aggregator, fell 3.17% and is being impacted partly by issues to do with its own business, but also, of course, question marks about the future direction of mortgage broking and mortgage volumes in Australia. Genworth, the lender's mortgage insurer, also fell down 3.21% on Friday to end at 2.11. And again, there are questions about mortgage delinquencies ahead. There are questions about the performance of their investments, and also just volumes, because volumes, of course, are currently quite a lot down from where they were in terms of new business. Now, the volatility index in Australia ended up 0.28% on Friday to end at 1862, and clearly at these levels is indicating significant risk in the markets. And this is an extended period now of high volatility, so we can expect, I think, more wobbles ahead. The US dollar, well, it ended up at 71.22, but of course it had dipped earlier in the week, down to 67 or thereabouts. And we expect to see continued pressure on the US dollar ahead. The reason that it moved up was not necessarily strength in the local economy, but a weaker US dollar, as we'll see a little later. The spot gold Aussie cross was down 2.31% to end at 1,805.03. Not surprisingly, if there is a move up in the markets, the gold tends to move in the other direction. And the Aussie Bitcoin cross was up 1.52% to end at 5,198, but a lot of that was to do with the exchange rate move rather than the underlying Bitcoin. So next week, I expect to see higher trading volumes as more people come back off leave, and extended volatility because there are still some fundamental questions to be asked about the Australian economy. Now, I did address Frydenberg's comment the other day that the banks should be lending more freely. I'll put a link to that, which includes my News 24 commentary. Essentially, my belief is that bank lending needs to be tighter simply because they were breaking the rules last year, and just looking for easy grabs of loan growth will not actually help us out of our hole. But of course, many of the senior people in the banking system, mortgage brokers and politicians have all come out in support saying we need more lending. Well, I'm not sure we do. Remember that our ratios are very extended and households are struggling with the repayments that they're currently making. We'll be publishing our mortgage stress data in a couple of days. So let's now look across to the US. And on Friday, the Dow Jones had a significant hike, up 3.29% to end at 23,433. And the reason for that was partly the strong payroll report, and there were also remarks from Federal Reserve Chairman Jerome Powell, who suggested that the central bank will be more flexible with regard to monetary policy. So, in fact, all of the major indices more than regained losses in Thursday's broad sell-off, showing around a 3% rise. Now, in terms of that data, the Labour Department's employment report showed that the US economy added 312,000 new jobs in December, which was way more than 177,000 that analysts expected. And Jerome Powell was part of a panel at the American Economic Association. And his comments soothed market nerves with assurances that the central bank is sensitive to risks that worry investors and is not on a present path of interest rate hikes. This is what he said.
I'll talk a little bit about 2018 and then turn to the outlook, if I may. So 2018, by so many measures, was a good year for the United States economy. And most of the hard data that we see coming in remain quite solid and suggest ongoing momentum heading into 2019. You mentioned this morning's jobs report. For those of you who haven't seen it, we had 312,000 payroll jobs added, a very strong number. We have unemployment remaining below 4% for 9 months now, the longest period since the mid-1960s. We have labor force participation picking up again and surprising to the upside, which is very, very welcome. And finally, we have wages, which are continuing to gradually move up. Average hourly earnings moved up, and that's quite welcome. And also, for me at this time, does not raise concerns about too high inflation. So very strong report today. We've also seen, on a more forward-looking basis, we've seen initial claims for unemployment insurance near their historic lows, and so that's more of a leading indicator, and we still see real strength there. Consumer spending has been strong right through December. The reports we're getting from the retail industry suggest continuing spending right through the holiday season. I would say those are all good data points. There is yesterday's Institute for Supply Management report, which came in well below expectations. And I would just provide a little bit of context there. The ISM report is a survey of manufacturing conditions, and it had been at historically high levels, in fact, higher than it had been even in the strong expansion of the late 1990s, and much higher than it had been during much of this expansion. So it's now at a level which is considered consistent with ongoing moderate growth. and is about at the level or even higher than it's been in the earlier years of this recovery. So that's a little bit of context. I would say the fact that it moved down so much in 1 month is something worth keeping an eye on. So notwithstanding that report, though, I would say U.S. data seem to be on track to sustain good momentum into the new year. I'll talk about China for a second. China's been a big part of this story, and the most recent data from China have been more mixed. China's consumers appear to be pulling back, as seen in the Apple news and in the weak retail sales data. The 2 PMI reports we got earlier this week show softening in domestic and external demand, and this weakness seems to be spilling over to other emerging Asian economies and to global commodity prices such as copper, for which China is such a big buyer. That said, Chinese authorities are responding with additional stimulus, and China and the rest of emerging Asia should continue to expand at a still solid pace this year. So overall, I would say the picture for the rest of the world remains consistent with continued growth here in the United States. So good data still, I think, is the story looking in the rearview mirror. But financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So you do have this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook and how should we think about monetary policy going forward? Now, when we get conflicting signals, as is not infrequently the case, policy is very much about risk management. And I'll offer a couple of thoughts on that to wrap up. First, as always, there is no preset path for policy. And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices. And I'd actually like to point to a recent example when the committee did just that in early 2016. And I mentioned this in this December press conference in passing. As many of you will recall, in December 2015, when we lifted off from the zero lower bound, the median FOMC participant expected 4 rate increases for 2016. But very early in the year, in 2016, financial conditions tightened quite sharply, and under Janet's leadership, the committee nimbly, and I would say flexibly, adjusted our expected rate path. We did eventually raise rates a full year later in December 2016. Meanwhile, the economy weathered a soft patch in the first half of 2016 and then got back on track, and gradual policy normalization resumed. Now, no one knows whether this year will be like 2016, but what I do know is that we will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%.
Now, there was also further good news in that the China and United States trade talks will kick off again next week. But remember, there are areas of public service that are still not being funded, and it looks as though that stoush could run on for quite some long time. The S&P 100 rose 3.55% to end at 1,126. And the S&P 500 rose 3.41% to end at 2,531. Now, looking at the S&P financials, they also rose up 3.28% to end at 402.54, having dropped significantly earlier in the week. And again, it's worth remembering this is on low volumes, but nevertheless, it was quite a significant turnaround. And Goldman Sachs, who is one of the bellwether stocks that I follow, was up 3.27% to end at 175.05. Again, you can see that dropped significantly lower than that earlier in the week. Now, the volatility index came significantly back on Friday, down 15.99% to end at 2138. So the market is essentially reacting positively to what Powell said, thinking that perhaps the rate of future interest rate rises will be significantly slower and that the Fed is clearly going to apply some flexibility. The Nasdaq rose 4.26%, which is a significant recovery, to end at 6,738.86, having dropped significantly lower earlier on. And there were a few things going on there. Netflix, for example, jumped 8.8% after Goldman Sachs added the streaming service to its conviction list. Intel was up 6.14% to 47.22. Amazon was up 5.01% to 1,575. Google was up 5.13% to 1,078. And Apple recovered, up 4.27% to end at 148.26, having previously given its warning of slowing trade with China. Turning to the bonds, the 10-year bond rose 4.63% on Friday to end at 267. And this now suggests that perhaps a yield curve inversion is less likely. Now, we discussed this yesterday. I'll put a link to my post about the yield curve inversion and the implications of it, suggesting perhaps that this is further away than people were thinking just a day or two ago. Whereas the 3-month bond rose just 0.09% to end at 241. Just to round out the statistics, gold futures fell 0.63% on Friday to end at 2,186.65. You can see, though, that the rate of climb since September has definitely been there as uncertainty in the market continues to play out. Bitcoin was up just a little, 0.58%, to end at 3,954, but is still well down on a year ago. And crude oil futures was up 2.59% to end at 48.31. Now, looking across to Europe, the British pound US dollar rose just a little, 0.03%, to end at 127.30. The euro to US dollar was 0.02% up to end at 113.95. And the US dollar index was down just a little to end at 96.20. The Chinese yuan US dollar was up 0.04% to end at 0.1456. The FTSE 100 was up 2.16%, reacting, I think, to the US news, to end at 6,837.42. And the FTSE Financial Services Index was also up 2.51% to end at 627.77. Of course, the whole Brexit discussion will reignite over the next few days, so expect more volatility there. Now, before I go, I want to discuss in more detail the discussions between Jerome Powell, Janet Yellen, and Ben Bernanke. And there were two very interesting comments. The first was from Janet Yellen, who made the point that there is still a lot of work to be done to think about systemic risk and how to deal with it. Listen to what she said.
Dr. Yellen, on regulation. A real emphasis of the Fed since the crisis has been macroprudential regulation, the idea of regulating the financial system, accounting for risks to the macroeconomy. How confident are you that the financial system we now have will prove resilient? Is there anything you would like to see the current Fed or other regulators do to strengthen that capacity?
Well, I think a lot's been accomplished, and the financial system is definitely in better shape. There's more capital, higher quality capital. The institution of stress tests is a very important supervisory innovation, maybe the most important in terms of aiding public understanding of what's happening in systemically important banks and encouraging better risk management in those banks. Derivatives are safer, many now that are standardized or centrally cleared. There are much higher margin requirements on those that are not centrally cleared. There's been money market reform. So a lot of things have happened that I think have left us with a safer financial system. That said, I'd say it's a work in progress, and there is more work to be done. I worry about the fact you said macroprudential tools. I actually think in the United States we have a shortage of macroprudential tools. So while we've made the system year in and year out more resilient, if we were to see a threat like house prices rising, we're concerned that a bubble is developing. Many countries have tools that a financial stability board could invoke. They wouldn't be invoked because anyone's worried about the safety of a particular banking institution. The concern would be that escalating house prices and the potential for a collapse could cause a deep and long recession. And many countries, for example, would raise, put caps on loan-to-value ratios and lending.
Canada's been doing some of this.
Right, and there are lots of countries, a lot of Asian countries are doing that as well. The Bank of England has tools as well that they've used. We actually don't have such tools in the United States, and that worries me. And although the Fed got new tools, if there were a problem in a systemic institution that would help to resolve a systemically important non-bank, say an investment banking sub of a bank holding company, we've lost some of the emergency lending powers that were used during the downturn, for example, to support AIG, whose collapse, I think, would have been disastrous at the time. So I do have some concern.
But interestingly, Jerome Powell also identified areas of more work and beyond the major financial system.
I agree with Janet that we don't have a lot of tools that we can move around as a cyclical matter. So we've had to make up for that by having through the cycle macroprudential policies, and I would characterize the stress test, particularly for the largest institutions, the stress test and also the very high capital requirements and liquidity requirements and resolution requirements that we have on the most systemically important. So those are through the cycle measures which are always on. I think we're not strong in terms of having tools that we can turn off and on. And frankly, that's just a fact of life for us. I think that there's a long history of and not a happy history of trying to use things like loan-to-value ratios. They don't survive very well. The other thing about the United States, of course, is that most credit intermediation takes place in the financial markets, not the regulated, supervised banking system, and that's just a different thing. You know, it's not the financial capital markets are not prudentially regulated. It's completely different, and it's a real strength from a capital raising and dynamism standpoint. But it's something we've worked on a lot, and I think that, I think what we've done with the banks is a good body of work, and I feel good about where the banks are. I also feel fine about the capital markets, but I think there's more to be done in central clearing, for example, and there's more to be done in the capital markets generally.
So it's interesting that he highlights questions around the central clearing of derivatives and also the question of capital markets regulation and whether sufficient has been done. Of course, this is all about international connectiveness. And if I put those two themes together from Yellen and Powell, what it really is saying is that as yet, the global connectivity and the global risks are still not fully under control, or indeed perhaps even fully understood. And that should be a concern. And finally, before I go, let me just say that there's been very little new news from the Australian perspective over the last few days, and I did actually cover home price movements and those other things in earlier posts this week, so I'm not going to repeat that now. Next week, of course, we'll be back to normal. There'll be more information flowing out, so expect more updates through the week, and we'll do another Property Imperative Weekly at the end of next week as normal. I'm Martin North from Digital Finance Analytics. If you liked what you've seen here today, please share the post, like the post, add a comment or question. I read them all. And if you haven't subscribed, please do so now to receive alerts for future updates. Thank you for watching, and I'll see you next time.